Hello. So we continue on the theme of financial globalization. And in this video lesson, I will then try to discuss the role of mutual funds and equity markets, also from the perspective of currency exchange rates. So recall from previous videos that we have discussed the major participants in the foreign exchange market, especially the role of commercial banks and multinationals and the central banks. So the purpose of this video lesson is to then a little bit highlight the important role of non-bank financial institutions such as mutual funds. And so I will refer to the very recent study by Helen Ray and her colleagues, which study the behavior of mutual funds. And they argue that mutual funds are like elephants in equity market, in the sense that observing the behavior of some of the mutual funds is enough to construct the behavior of the entire market. So they look at the data of American mutual funds that invest globally, and although these mutual funds only cover only on average about 5% of the market capitalization, then their equity holdings actually can explain on average about 89% of the time variation in over 20,000 individual stock prices around the world, and 96% of the fluctuations in 33 different stock markets. So that kind of gives an impression that anyway that how much influence of let's say American mutual funds have over the equity markets around the world. So according to their study, the changes in portfolio weights of these mutual funds explain most of the variation in individual stock prices. However, the overall stock market fluctuations depend more on the aggregate wealth effects. So this is one of in my impression, one of the first serious economic studies that look at the influence of the mutual funds. So there's also influence on the exchange rates with these global equity markets. And interestingly, the study identifies three so-called safe haven currencies, which are the US dollar, the Japanese yen, and the Swiss franc. And as one could expect that for currencies outside of this safe haven group, so for example, euro, the exchange rate tends to appreciate when the equity holdings increase. So that implies that the local currency equity prices need to increase by less in order to clear the equity market. But then these three safe haven currencies, US dollar, Japanese yen, and Swiss franc, they behave somewhat differently because they provide an unconditional hedge for foreign equity investors with respect to local stock market fluctuation. So this explains that why these three safe haven currencies tend to depreciate when the stock market goes up and appreciate in bad times. So, for example, if the U.S. stock market has a bad time, has a bear market, then in fact the US dollar tends to appreciate rather than depreciate. Whereas for the euro and the European stock market, it would go other way around. So if you're interested, you can read more about this directly in the paper. So I have the link here on the bottom of this slide. In the next video, then I will discuss the concept of purchasing power parity and how that is also used for measuring the exchange rate, especially in the research work. See you then.